In this presentation, we'll take a look at our financial statements, our reports after the second month of data input using the bank feeds. Let's get into it with Intuit's QuickBooks Online. Here we are in our Get Great Guitars file. We're going to be opening up our reports on the left-hand side. Opening up those reports, our two favorite reports, that being the balance sheet, that being the income statement. Starting off with the balance sheet. We're going to be changing the dates up top. Let's change those dates to, or let's go from 01/01/20. Let's make it up to 04/30/20. Let's go ahead and run that report. Then we're going to duplicate that report by going to the tab up top, right-clicking on that tab up top and duplicating it. Then we're going to go back to the tab to the left so we can open up that P&L by going to the reports on the bottom left. Then we're going to be opening up that P&L, that profit and loss, that income statement. We're going to be changing the dates up top, same range from January on over to April, which is going to end at 04/30/20. 04/30/20. We're then going to run that report. Then I'm going to right-click on the tab up top and duplicate that report as well. So we have the balance sheet, then the P&L. Let's first start off on the balance sheet, going back to it, closing up the whole hamburger so we get that out of the way, doesn't make us hungry. We're going to scroll up to about, let's make it the 125. That's where I like to be. Okay, and then we're going to change the range up here. We have it as of April, and we've entered the data up through April and done the reconciliation. Let's do some comparison by saying, instead of going for the totals only in this tab up top, we're going to make this by month. So let's go by month, and then run the report. And that's going to give us this information for January, February, March, and April. Now remember, what the balance sheet means is that we're as of a point in time. So this is as of January 31st, March or February 29th, because it's 2020 and there's 29 days in it. And then March 31st and then April 30th here. So we can see where we stand as of the end of those time periods. So you'll note, just looking through this, if we think about cash, the first 2 months we ran on a full service system. The last 2 months we ran just using bank feeds, more on a cash basis. If you were only using the bank feeds, and notice the last month we kind of deviated from that on the deposit side of things, then going back to entering invoices and thinking how that would work in a bank feeds, with bank feeds. But in any case, these 2 months then, if we were depending totally on bank feeds, you would think that the cash would tie in. If we were doing only bank feeds to what's on the bank statements, notice you'll have the timing difference on the cash over here. Remember, with the accounts receivable in March, we didn't include any accounts receivable because we didn't use invoices. We were dependent only on the bank feeds. And in that case, you're more on a complete cash basis and you wouldn't have any accounts receivable. We have some here, of course, because they're tying over from the prior system, and these are permanent accounts. But just remember, full service system, you might be going through accounts receivable using invoices, having outstanding items until you receive the payment. If you're on a cash basis, simply getting payments, you won't have the accounts receivable. You won't have, and the accounts receivable itself, by definition, is an accrual account. So if you have information or money that you're just getting paid by Amazon or something like that, then you may not have any need for sending out the invoice. You're just going to get the commission payments or something like that, and therefore that system would work. You can also use bank feeds. You'll recall in April we used the invoices and used bank feeds, but that's more of a matching feature that we'll be using rather than depending on the bank feed data to enter all of our data directly from the bank statement. Inventory, you'll recall in the first 2 months, if we think about a full service system, within the first 2 months, we would be tracking inventory, tracking it within QuickBooks. In the third month, then we thought about how we could think about inventory and track it outside of QuickBooks, possibly. If we have inventory, then not track the inventory through the system, track it outside, and or even not track inventory, but be on more of a just-in-time system and go to a direct cash basis, which means we basically expense the inventory as we purchase it. So if you're a contractor or something like that and you're working on a job and you're buying wood or things like that, then maybe you just expense it as you're working on the job, even though you have the wood kind of in the warehouse for a little while, or in the garage or something, until you're done with the job. Then you might just cost of goods sold, expense it. That would be the easiest thing. Or in April, we thought about a system where we're going to not track that information in QuickBooks, but maybe track it in some other system using a periodic inventory system, in which case we count the inventory at the beginning of each day or week or month. We then count it at the end. We record the purchases in the system, then count the inventory at the end, and then make an adjustment for cost of goods sold. So those are if you don't have inventory, then of course a direct relying on the bank with the bank's feeds is a more viable option. It's an easier option without having to deal with that added complexity. Then we had the E-Trade on the investments. That's going to be pretty much similar for how it would work with bank feeds or without. Undeposited funds, so that's when we get paid before, if we got paid before we did the work. In that kind of situation, if you're on a cash basis system, you wouldn't even be using undeposited funds. You would just record the deposit when you received it, even though you had not yet done the work. And so then we didn't talk about that too much, but then we have the furniture and fixture. Recall that if you buy large pieces of items, pieces of equipment, even if using bank feeds, you're still going to have to put it on the books as an asset typically. So that means you're deviating from a cash basis. You're going to an accrual basis, and you kind of have to, because it's going to be a large item, and even the tax code when you're on a cash basis makes you do that. And that can be worked into the bank feeds by simply looking for those large items and then breaking them out. And we'll talk about possibly rules that we could set up in the bank feeds to help you to do that. Then the depreciation related to the equipment, the accounts payable. Remember on the liability side, it's possible for us, in other words, to be more on an accrual basis for, say, up here, accounts receivable, which many small businesses are very concerned with tracking if they have that kind of business that deals with AR, accounts receivable, tracking what customers owe us rather than just making sales at the point in time that we do the work, and may not be as concerned with an accrual basis on the payment side of things, because they may make their payments directly cash, right, or at that point in time, and may not need to track the accounts payable as much. So note that in that situation, the bank feeds work really well to be on a cash basis system for bank feeds for the vendor side of things for the payments, and you may need to have a more complex system adding some accrual features with regards to your income or your asset side of things, your accounts receivable. So accounts payable, like accounts receivable, however, if you need to track your vendors and see who you owe and you want to do that within QuickBooks, that's adding an accrual feature, stepping away from a cash basis, making it a little bit more complex to work that with the bank feeds. You got to think about how you're going to fit that into the system. Credit cards, we're going to talk about later. You could do a similar process with credit cards with the bank feeds with your credit card statements for your bank or a Visa, whoever's with bank, MasterCard, and American Express will typically have bank feed options. And then we had the payroll taxes. We talked about kind of how would you work in payroll taxes. Again, you wouldn't have payroll taxes unless you're dealing with the inventory, typically, if you're in the United States. And so then you got to think about, well, if you're on a cash basis system, how would you talk about payroll taxes? We went into that a bit. And then we have the notes payable. How can we track the notes payable that's going to be paid? How can we track the payments and break them out between interest and principal if we're using a cash basis, depending on the bank, using the bank feeds? We talked about a couple systems to do that. And then the notes payable down here, and then the equity. Now let's take a look at the P&L and do the same thing. If I go to the profit and loss, this is where we have the performance. So this is really the report that we can kind of compare the accrual versus the cash basis here. Let's do the same thing by going up top and changing from the total only to the months, and then go run that report. This is a timing report, meaning we're looking at January 1st to the 31st, January 1st or February 1st through the 29th, and so on. So it's a beginning and end type of report, and that's why we can have the total column over here, because this is accumulating all the way up from January up through April. So if we look at the income side of things here, you'll recall January and February, we did the full service items where we entered invoices and sales receipts. Then in March, we were dependent completely on the deposits. So we were dependent completely on the deposits in March. And then in April, we thought, let's step away from that and think about how we might want to deal with invoicing and possibly sales receipts and how that might work with bank feeds. So we worked in bank feeds and more of a full service cycle that would happen on the sales side of things. So if we go into the reports here and I change the dates from 01/01/20 and I run the entire thing, you'll note that in January, we've got sales receipts driving the activity, and February invoices. So we're actually using the system. If I go back up here, we're using sales receipts and invoices that are driving the sales. These are what the two documents that typically record sales here. If I close this back up, invoices, and then in April, we entered the sales receipts and invoices. So in April, we enter the invoices and sales receipts as well, and work that in with the actual deposits, thinking about how we can use the bank feeds in the same system. Let's go back to the report summary, and I'm going to scroll back down. Let's check out this 21/6/30 that we had in March. And again, I'm going to change the dates up top for the whole time period from 01/01/20, and then 3/31 is fine. Now, again, in here, in the first 2 months when we had the full service items, a full service cycle, we had invoices and sales receipts. And then down here, however, we were dependent directly on the deposits for March. So in March down here, we just entered the deposits, and you'll see some other items in March, but they're zeroed out. So that's the difference between the bank feeds here, where we were dependent completely on the bank. We just said, hey, if it's a deposit in the bank, it must be income. And then we recorded the income for it. We didn't record what would typically be recording income in a normal process, that not being deposit forms, but invoices and sales receipts for QuickBooks. Going back up top, and then we're going to go back to our data. Then we have the expenses. So if we think about the expenses, again, January and February, we've got the bank service fees. We have a similar process for March and April because those came directly from the banks and the bank feeds. When we look at February, we had depreciation, insurance, and interest expense. These are adjusting entries. So whether we're on a full service kind of cycle or we're using bank feeds, we would typically be reliant possibly on a CPA firm or an adjusting department or on ourselves to go in there periodically and make period end adjustments, which we have not done for March and April. So that would be why the depreciation is there, and that's where some of the interest expense was generated from. Well, not all of it. That's where the depreciation is from. And then the insurance, you'll note here, was an adjusting entry. We put it on the books as an asset, and then we did an adjusting entry in February. In April, we're on a cash basis, and we just wrote off a whole year's worth of insurance just to do that comparison and see the difference between the two. So April's insurance is going to throw us off. It's going to make our net income a lot lower than it otherwise would be because we wrote off the whole thing on a cash basis. And then the interest here, it might be part of it because of an adjusting entry, but part of it is also due to the fact that when we wrote the interest off on our system, that's going to be interest on the notes payable that we pay off. We put the interest into just reducing the actual note amount. And then we want to depend on an adjusting entry to tie us into the amortization schedule, because that's easier to do with the bank feeds, because then you don't have to adjust the bank feed for the portion breaking out between interest and principal. And then we had the supplies. So we had office supplies in January, and we have office supplies in April. Now note, we mirrored March and January in terms of the bank feed data, and it cleared the bank. It didn't clear the bank in January. So if I go into the office information here and we change the dates from January to let's just make it 12/31/20, run that report. In January, it was a check that we wrote. We wrote a check, and then we entered the same data in January as we did with March. But notice this check didn't clear, so it didn't clear the bank. So even though it was a cash transaction, it should be in the system on a cash basis. It didn't clear the bank until April. So even though we wrote it in March, it didn't clear until April. And therefore, if we're dependent on the bank feeds, we wouldn't have it in our system until April, even though we wrote the check in March. So you still have that lag, not just in terms of a cash basis versus accrual, but also between the time where you know the transaction happened, you wrote the check, and the time in which it cleared the bank, It could be a crossover between the months as well between that. If I go back to our data, then we have the other miscellaneous expenses, which we put here. We've got the payroll. You'll note the payroll, if we use an accrual kind of system or we process the payroll, it's a nice smooth system here. You've got payroll happening. If you're using a cash system and you're kind of dependent on a third party and you're waiting till the payroll checks clear the bank, then again, it kind of depends on when, if you write in a check, when the checks got deposited. So you'll see that this deposit here could include both the payroll items. Also note that we're going to have to wait until we pay the payroll liabilities, and we'll have to see it until it goes through the bank, at which time we'll record the payroll liabilities as well, instead of recording a liability on the balance sheet if we're dependent on bank feeds with regards to payroll. So payroll is another item, another area we may need help with for adjusting entries at the end of the time period, month or year, for financial statement or tax preparation information. Then we have the repairs and maintenance. We mirrored the repairs and information here. So those were cash transactions that happened and they cleared the bank in the same month. So we had February, we had the same information in March that we entered. Then we had the telephone. So here's the January and February telephone. Same situation here happened with the telephone. If I go into the telephone data and we change the dates up top from January to, let's make it 12/31/20, run that report. We had an expense in January. We're going to say it's like a check, let's say, but it didn't clear the bank until February. So in a full service system, it would go in the books in January. We mirrored that data in January in March, right? We mirrored it in March, but the item that we entered in March didn't clear the bank until April. So that's why there's a difference in timing difference, again, due to the timing difference. We would have known about the transaction when we made it, but it may take some time to clear the bank. And then in February, we entered a bill for the telephone. And when we were running the system on the bank feeds, we would never enter a bill. We wouldn't enter the bill because we're just using the bank feeds in order to enter the information. So we're not going to use accounts payable if we're doing a completely cash basis system. So let's go back into our reports then. See what else we have down here. That was the telephone, and then the utilities. So we've got the utilities that are mirroring out like they should. So here's January, March, and then February and April, where we use the same data there. So those are mainly the items I wanted to take a look at. The net income's a little bit distorted here because we had some outstanding items or accounts receivable that cleared in the later months. So the net income is not as telling as it could be if we kind of started from scratch on that. But hopefully, as we go into each of these accounts, you can kind of see the difference that might happen from a full service kind of system versus one that's dependent on the bank feeds, some of the things that you may gain, some of the things that you may sacrifice.